Michael, one day all this will be yours.
This?
See this junker? I paid $100 for her. She's got 120,000 miles on her. Transmission shot, bumpers have fallen off. What do I do with her? I sell her. We really should weld these bumpers on, but that takes time, equipment, money. So, we use super glue instead. Go ahead, put it on there.
Won't it fall off?
Definitely.
Isn't that dangerous?
Not to me, okay? Transmission. The sawdust quiets the gears and lets the engine run as sweet as a nut for a couple of miles.
Daddy, that's cheating.
Of course it's cheating. Nobody ever got rich being honest. 20 years ago, we could turn the numbers back by hand. But here, take my hat. But the feds like to test the ingenuity of the American businessman. Two-directional drill. You run it backwards, the numbers go down. Watch your speedometer.
Cool.
See?
Yeah. Daddy, you're a crook.
What?
This is illegal.
Yeah, keep drilling. Do you make money? Do you have a job?
No, but don't people need good cars? Can't you sell good cars, Dad?
Listen, you little wiseacre. I'm smart, you're dumb. I'm big, you're little. I'm right, you're wrong. And there's nothing you can do about it. Whoa. Ah. Way down there.
If you are not familiar with this movie, this is Matilda. Danny DeVito plays Matilda's father who sells cars for a living. And in this scene, he was teaching Matilda's brother how to sell cars for a handsome profit. However, our topic for today is not about how to earn income by scamming customers. Our topic is revenues, and specifically how to audit revenues through substantive procedures, through substantive audit procedures. So welcome to our training session for today. I would like to emphasize that this training for revenues focuses on certain substantive testing procedures only and assumes that no tests of controls were performed by the audit team. Tests of controls and their impact on substantive testing will be discussed in other training courses. Auditing the core revenue of our clients is best done in conjunction with the audit of trade receivables, since the journal entries for trade receivables and the core revenues, remember the core revenues, go hand in hand. Matters that impact revenue are highly likely to impact the trade receivable balance as well. So for an efficient audit, trade receivables and the core revenues should be audited together. So kung sino yung nag-audit ng receivables, preferable na siya rin ang mag-audit ng yung core revenue. So let's start this session by discussing the training objectives of this session. So what are our training objectives? At the end of this training, I hope that you would have obtained a basic understanding of revenues, learned about some of the common risks and fraud risks relating to revenues, learned the principal audit objectives in auditing revenues, and finally, learn about the substantive audit procedures typically performed on revenues. This training will be conducted in the same order as these training objectives. So let's start with revenues. Revenue is typically the biggest single line item on the income statement. So before we start discussing how to audit it, I think we should brush up on our basic knowledge of revenues first. As you all know by now, we will not be able to perform audit procedures properly and effectively if we don't even know anything about the account we are about to audit, including revenues. So to do this, let's start with the most important question, which is, what are revenues? Revenues, more commonly referred to as sales, pertain to the income or money that a business generates from and brought into the company through its primary business activities, such as sales of goods and or services, less any discounts, rebates, or returns. For example, a pharmacy will generate its revenue through the sale of medicines or a supermarket from the sale of groceries. An accounting firm, on the other hand, will earn its revenue by providing services to its clients, while a property owner will generate revenue from renting out its property. In other words, revenues can be derived from many sources or streams, and each revenue stream could have differing ascribed recognition method under the full PFRS, PFRS for SMEs, or PFRS for small entities. As auditors assigned to audit revenues, therefore, we need to familiarize ourselves with our clients' revenue streams, including the correct revenue recognition method for the type of revenue or revenues our client has. Hindi tayo pwedeng mag-audit ng revenue na hindi natin naiintindihan yung revenue process ng company. So what are the major types of revenues? In general, revenues can be grouped into two major types. These are operating revenue and non-operating revenue. Operating revenues are income generated from the company's core business, such as the sale of products for a product manufacturing company, granting of loans for banks, constructing buildings, and other structures for a construction company, etc. So basically, ito yung main revenue stream. For non-operating revenues, which is also called the secondary sources of revenues, these are usually earned infrequently or are non-recurring. So ito yung mga paminsan-minsan lang. Examples of non-operating revenues are tax refunds, proceeds from the sale of fixed assets, awarded proceeds from litigation, interest income on bank deposits, etc. Revenues can also be gross revenues or net revenues. Gross revenues pertain to the amount of total income earned or money brought into the company before any deductions coming from discounts, returns, or rebates. When the account is simply presented as sales or revenues in the income statement, it is presumed to be at gross. So remember that pag walang nakalagay na net, at gross siya. Pinipresume siya at gross. It is because both the accounting standards and the BIR require the disclosure of deductions made from the revenues. So if no disclosure was made about revenue deductions, then the revenue amount presented in the income statement is considered to be without no deductions and therefore considered to be at gross. Note that taxes such as value-added tax should not form part of the gross revenue amounts. Now, net revenues or net sales, on the other hand, pertain to the amount of gross revenues less discounts, rebates, or returns. Although I also assume that you know already, I still would like to point out, especially for any non-accountant who may have attended this training session, that net revenues are different from net profit, which we also commonly call net income. Net profit or income pertains to the income left after deducting all costs and expenses from net revenues, both operating and non-operating. So what are the different types of revenue streams? Revenue streams pertain to the various sources of revenues of a company or organization. An entity can have either just one or more than one revenue stream. It all depends on the types of business activities that a company may have. For example, a company may be selling both goods and services, like a beauty salon which can sell both beauty products and salon services, or a hotel that also can sell both services and food and beverages at the same time. The sale of goods and services can be further segmented by the company into more detailed revenue streams. For example, the sale of poultry and sale of feeds for a company selling both products. In general, however, revenue streams can be put into four categories or types. These are recurring revenues, transaction-based revenues, service revenue, and project revenue. Let's discuss each one briefly. For recurring revenues are revenues that by their name pertain to those earned from continuing services or after-sales services to customers, hence are likely to continue to be derived regularly by the company for a significant period. So tuloy-tuloy siya. Recurring revenues are usually generated by companies that sell subscriptions such as Netflix, Hulu, or Spotify, or by companies that sell other services continuingly, such as property lessors, brokerage firms, content licensors, phone line and internet service providers, utility companies, etc. Recurring revenue is typically recorded regularly, for example, monthly or yearly. The next is transaction-based revenues. Transaction-based revenues typically arise from the sale of goods that are on a per-transaction basis. For example, a sale of a washing machine or groceries to a customer derives a transaction-based revenue, as opposed to a recurring revenue which essentially guarantees to generate revenue regularly over a while. Transaction-based revenues rely on the occurrence of a revenue-generating transaction from a customer or customers. Kasi pag nagbenta ka ng goods, hindi naman automatic na everyday bebentahan mo siya or every week bebentahan mo yung tao. So that type of transaction is a transaction-based revenue. The next type of revenue is service revenue. Service revenues are those revenues derived from the selling of services, the amount of which is calculated based on time spent by the company's employees. An example of this revenue is the fees earned by law firms, accounting and auditing firms, and other consulting firms. This type of revenue stream is sometimes used in combination with other types of revenue streams. And the last type of revenue is project revenue. Project revenues are revenues derived through one-time projects with new or existing customers. Because it involves one-time projects only, this type of revenue is harder to predict because foretelling what the future holds is difficult to do. An example of this is the revenue of a subcontractor company that is dependent on the project that the primary contractor extends to it, or the revenue of a web developer that is earned on a per project basis. So those are project revenues. Is it really important for us to understand that these types of revenue streams? The answer is yes. As we all know, the amount of revenues is always a key performance indicator used by companies. So understanding the types of revenue streams our client has will assist us in designing the extent and nature of the audit procedures that will be performed on each revenue stream. For example, if our client has both a recurring revenue stream, say rental income, and a transaction-based revenue stream like the sale of merchandise, then we would know that testing the recurring revenue stream would probably consume less of our time compared to the transaction-based revenue stream, since we can probably easily do simple predictive testing of the recurring revenues based on the terms of the lease contract. Conversely, transaction-based revenues tend to fluctuate and can be affected by many things, such as the economic condition, seasonality of the products, effects of changing technology, customer preferences, etc. Accordingly, the nature and extent of the audit procedures that will be performed on such revenues will be much different from the recurring revenues and may take more of our time. What balance sheet accounts are connected to revenues? different revenues are connected to certain balance sheet accounts, such that for a more efficient audit, we should consider examining or reviewing these revenue accounts in conjunction with the audit of the related balance sheet accounts. Although not complete, here are some of the balance sheet accounts and the related revenues that could be reviewed or audited together So for cash, the revenues that we can review together with cash are revenues not processed as part of sales and accounts receivable application and interest income. For marketable securities, we can review with marketable securities, dividend income, interest income, and gain from disposal of the marketable securities. For receivables, obviously sales and interest income on notes receivable. For investments, we can review dividend, interest income, and gains from disposal of investments. For advances to related parties, we can review the interest income from the receivables. For fixed assets, we can review the gain from the disposal of fixed assets. And finally, for investment property, we can review with this account the rental income associated to it. So to conclude this basic understanding of revenues, let's enumerate some other important information that we should consider knowing about revenues. This information could assist us in developing and executing the audit procedures on revenues. Please note, however, that the following list is not all-inclusive and therefore other information may need to be understood by the auditors as well, depending on the circumstances of the client. Also, what information will be included in understanding of revenues is a matter of professional judgment by the auditor. So let's review the list, which I believe is self-explanatory, hence no further discussion will be done anymore. So we will just enumerate them. The first thing that we need to gain an understanding of is the revenue recognition policy. Next is nature and sources of revenues of the client, the types of customers of the client, incentives, if any, that are tied up to revenues such as sales commissions or bonuses. So kung nagbibigay ng ganitong mga incentives yung kliyente natin. The pricing policies of the client, credit and repayment terms that were given to customers, how the company calculates credit losses on receivables or doubtful accounts, sales returns, discounts, and rebates policies, if any, we have to understand them. The impact of external factors to the company's revenue, such as competition, the prevailing economic condition, laws, changing technology, etc. And the last one is distribution channels where products are sold and services provided. So paano ba nila binebenta or binebenta yung services nila or goods? So essentially, these are all the typical information that we have to obtain an understanding of before even performing any substantive procedures on the revenues. Basically, dapat alam natin ito before we perform the substantive testing procedures. So let's now move on to the common risks associated with revenues. Knowing and understanding the common risks associated with revenues and some common ways how companies perpetrate fraud regarding revenues is important and will help auditors like us in our risk assessment process and in designing the appropriate audit procedures to be performed in the audit of revenues. So let's discuss first the common risks associated with revenues. Revenue is the lifeblood of any company. It is what keeps companies alive. Without revenues, companies will not earn profits. Without profits, no one will invest or lend money to any company, and the company will be forced to stop its operations and existence at some point. In other words, without revenues, companies and businesses will cease to exist. Revenues are so important that erring companies always find ways of manipulating the amount to deceive their investors and other stakeholders. Just try to scour the internet and you'll find so much news about companies caught manipulating their revenues. And most of the material misstatement in revenues you will find typically result from their overstatement. For example, companies overstate their revenues by recording phantom or fake revenues or by recording revenues in advance. What about the understatement of revenues? Is this even a thing? Although most intentional misstatements of revenues pertain to overstatement, there are also instances when revenues are misstated due to understatement. Although it could be intentional, understatement in revenues arises from erroneous recording mostly. Revenues are so prone to fraud that the auditing standards even made a specific provision regarding fraud considerations relating to revenues. So sa auditing standards, merong section talaga na ginawa specifically for fraud recognition fraud relating to revenues. This makes revenue a high-risk account and therefore should be given due consideration in auditing the account. So dapat sa lahat ng kliyente natin, high-risk palagi ang revenues. Never siyang nagiging low risk ang revenue because nga of its susceptibility to fraud. So let's discuss the following common risks relating to revenues. Improper revenue recognition policy and inadequate financial statement disclosure, intentional overstatement of revenue, and improper cut-off of revenues. Please note that the risks we are about to discuss are not all inclusive. There can be more risks associated with revenues depending on the circumstances of our clients that we may not be discussing today. But anyway, let's briefly discuss each of these common risks. The first one is improper revenue recognition policy and inadequate financial statement disclosure. In general, an entity recognizes revenue when goods are sold or services exchanged for dissimilar goods or services in a transaction that has commercial substance. Simple, right? Nope. The accounting standards require several conditions that have to be met first before revenue can be recognized, how they should be measured, when they can be considered as revenue, etc. PFRS 15, Revenue from Contracts with Customers, which became effective in 2018, even totally changed the basis of revenue recognition for companies that use the full PFRS framework. For a very long time, revenues under PAS 18 were recognized when the risk and rewards over the goods or services have transferred to the customer. However, PFRS 15, which superseded PAS 18, totally changed the rule and now mandates companies to recognize revenues based on the transfer of control over goods or services instead, and then further prescribe a 5-step method that a company has to apply before recognizing a revenue. Because of these various accounting rules which companies have to consider first, the risk associated with revenue recognition becomes quite high. So parang because of the change and the 5-step process that the companies has to undergo before recognizing any transaction as revenue, mas nagiging high ang risk for misstatement ng revenue. The disclosure requirements prescribed by PFRS 15 regarding revenues are also quite extensive, such that the risk of inadequate disclosure in the financial statements are also usually assessed high. As auditors, we should be knowledgeable in the requirements of PFRS 15 or other relevant accounting standards to be able to audit revenues effectively. So siguro pag nakakita kayo ng FS na full PFRS, makikita nyo ang haba-haba ng mga disclosure about revenue recognition. Another common risk is the intentional overstatement of revenue. As we have mentioned in the training session for auditing receivables, most of the accounting scandals that have shocked the business world involved in overstatement in revenues. For example, Waste Management Inc., a publicly traded company in the US, was accused in 1998 of reporting $1.7 billion worth of fake earnings. The Federal Home Loan Mortgage Corporation, on the other hand, was accused of misstating over $5 billion in revenues. So why revenue? It is because a high level of revenue is perceived to be a healthy indicator for a business. Thus, most stockholders are interested in the revenues of the businesses they have a stake in. Some companies, therefore, intentionally inflate their revenues to attract investors, suppliers, and creditors. The last common risk related to revenues that we will discuss for today is the improper cutoff of revenues. Why does cutoff and not completeness pose more risk to revenues? It is because, as mentioned earlier, companies tend to overstate their revenues and not to understate them. This means that the recorded revenue would likely consist of complete revenue plus the revenue overstatement. Accordingly, misstatements will most likely come from recording future revenues to the current revenue or an improper cutoff of revenue. However, I would like to emphasize that we should also be wary of revenues being understated as well. When there are weak internal controls in the company's financial statement closing and reporting processes, recording of revenues in the wrong period can happen, such that understatement or overstatement of revenues could occur because of improper execution of revenue cutoff. However, while its occurrence may be less than overstatement, intentional understatement of revenues can also happen depending on an erring company's objective in understating the same. For example, meeting debt covenants may be, or trying to reduce the taxes paid, or for any other reason the erring company may have in understating their revenues. Aside from the common risks associated with revenues, let us also discuss three of the most common ways erring companies perpetrate fraud on revenue. However, other and more sophisticated fraudulent revenue activities will not be discussed today. Such topic will be discussed in other training sessions. But today, only the following three ways on how fraud is perpetrated on revenue will be discussed. So these are the things that we should be alert for during the course of our audit. The first one is accelerated revenue recognition. The second one is phantom sales. And the third one is third-party transaction. So let's discuss each one. Accelerated revenue recognition. Reportedly, the US SEC has identified improper timing of revenue recognition as the most common type of accounting fraud. As we have discussed previously, erring companies would accelerate the recognition of revenues even if such revenue should not be recognized until a later period. For example, the company records cash receipts meant to be, say, reservation deposits only as revenues already, even if the goods or services or service obligations accompanying the deposit have not been performed yet. So deposit pa lang, nire-recognize na nila as revenue. Another example is when companies ship goods earlier than the customers have asked for them to be shipped. Although not 100% the same, this type of activity appears similar to the case of a giant sportswear company that is currently under investigation by the US SEC for allegedly pulling forward sales from future quarters to hide slowing demands for their athletic apparel. According to reports, the company allegedly shipped and transferred their products to retailers earlier than expected and redirected goods intended for factory stores to off-price retailers and chains to sell more in the final days of a quarter. The company, however, maintains that its revenue recognition is proper. So basically, ang ginawa ng company ay actually very known company ito, very well-known company. Ang ginagawa nila to fast-track their sales, kahit hindi pa due na ibigay sa mga retailers nila, siniship na nila sa retailers nila. The next is phantom sales or fake sales. Another common way of inflating revenues is to recognize fake sales. Airing companies go to great lengths to recognize revenues related to fake contracts or other non-existent sales. For example, they could create orders from fake customers, create fake invoices and delivery receipts, and record fake sales. This is similar to the reported case of Anicom Inc. that happened years ago. It was reported that Anicom, a wire and cable company, was accused by the US SEC of inflating its revenues by booking millions of dollars in sales from one fake customer. So meron silang isang fake customer na doon marami silang sales na na-recognize relating to that one fake customer. The last fraud on revenue is third-party transactions. Another common way of perpetrating fraud on revenue is through the bill and hold sales, consignment sales, side letter agreements, and other contingency sales. In the bill and hold sales method, the airing company recognizes revenues from a customer when there is simply an intention on the part of the customer to buy goods, or when the company already recognizes sales even though the goods for sale are not yet manufactured or on hand ready for delivery. For consignment sales, the company records sales already when it transfers goods to the consignee and not when the consignee makes sales to third parties. So once na dineliver nila sa consignee, nire-recognize kaagad nila na sales, which is incorrect. So those are the three common ways of perpetrating fraud on revenues. Let's now move on to the audit objectives. The importance of understanding or knowing the principal objectives in auditing account balances, and in this instance revenues, cannot be emphasized enough. As I've said again and again, the audit objectives are here to guide us in achieving our main goal of ascertaining whether the balance sheet accounts are fairly stated as at the balance sheet date, or whether the income statement amounts are reasonably stated for the period then ended. Accordingly, similar to the training sessions held for other accounts, we will also discuss first the principal objectives in auditing revenues. So these are the principal audit objectives in auditing revenues. So let's briefly discuss each one. The first audit objective in auditing revenue is to ascertain that all sales included in the income statement represent the exchange of goods or services with customers for cash or other consideration during the period. As has been mentioned in the training for auditing receivables, revenue is the most common account manipulated by airing companies. The manipulation in revenues typically pertains to the overstatement in the amount of this account to show better results of operations. This rampant intentional overstating of revenues, in fact, even resulted in the Philippine Standard on Auditing and International Standard on Auditing 240, entitled The Auditor's Responsibility to Consider Fraud in an Audit of Financial Statements, to provide a specific paragraph for risk of fraud relating to revenue recognition. Accordingly, auditors should ensure that those audit procedures that will help in achieving the audit objective, which addresses the assertion of existence and occurrence, are tailored and performed for our clients. The next audit objective is to determine whether all sales and other revenues that accrued to the entity during the period are included in the income statement. This audit objective is somewhat the opposite of the first audit objective we discussed. If the first audit objective aims to ascertain that revenues are not overstated, this audit objective, on the other hand, aims to ensure that revenues are not understated and that all revenues earned by the company are recorded properly and in the correct accounting period. This objective addresses the cutoff and completeness assertions. But would a company even try to understate revenue? Does it even make sense to present lower revenues? After all, every company would want to present higher revenues and profits, right? Well, the answer is probably yes. Most companies would rather have overstated revenues rather than understated ones. But as mentioned in the training for receivables, there might be some reasons why a company would intentionally understate revenues, such as meeting the maximum threshold of, say, a current ratio set in its debt covenant with the lenders. In this instance, the company may manipulate trade receivables and the related revenue and other current assets or liabilities to meet the financial ratio. Also, not all understatement arises from intentional manipulation of revenues. Understatement in revenues could also be the result of errors in recording the revenues in the wrong accounting period. For example, some current revenues may be erroneously recorded in the subsequent period. This happens a lot when a company's internal controls over revenue recognition and financial statement close processes are weak or deficient. Regardless of the source of possible understatement in revenues, however, auditors must be able to design and perform audit procedures that will ascertain the proper cutoff of revenues. Another audit objective is to ascertain whether the sales and other revenues are stated in the income statement at the appropriate amounts. This audit objective addresses the measurement and valuation for receivables assertion. This is also the audit objective, together with the first and second ones, that will require the auditor assigned to audit revenue to brush up on their knowledge on the proper accounting treatment of revenues under the new PFRS 15. Not understanding the requirements of PFRS 15 will surely make the audit execution for revenues both ineffective and inefficient. The fourth and final audit objective is to ascertain whether the sales and other revenues are properly classified, described, and disclosed in the financial statements, including notes in conformity with prescribed accounting principles. PFRS 15 requires a lot more disclosure about revenue and its recognition compared to its predecessor, PAS 18. Accordingly, the auditors must ensure to design audit procedures that will make sure that this audit objective will be achieved at the end of the audit. So let us now discuss the substantive procedures typically performed on revenues, which is our main topic for today. Auditing of revenues may not be as straightforward as you think it might be. The audit procedures may be straightforward, but the accounting knowledge you have about revenues is crucial to the execution of the audit procedures. In this regard, because of the complexities in revenue recognition, the staff assigned to audit this account should have the proper level of skills and experience to effectively execute the audit. Assigning an auditor not familiar with auditing revenue may result in an inefficient audit, which can cost the auditor time and money. So let's now briefly discuss some of the substantive audit procedures performed on revenues, starting with gaining an understanding of the company's revenue recognition policy, including the revenue sources. Revenue recognition is an accounting principle that sets the criteria when and how revenue should be recognized, among others. There are so many different types of revenues that theoretically speaking, there are also various potential points at which revenue can be recognized. In this regard, PFRS 15, which supersedes PAS 18, provided a 5-step process that all companies need to follow before recognizing any revenue. Let's review those 5 processes. The first step is to identify the contract. The second step is to identify the performance obligation. The third step is to determine the transaction price. The fourth step is to determine the allocation of the transaction price to the performance obligations. And the fifth and last step is to recognize the revenue when or as the performance obligation was satisfied. The various types of revenues coupled with this 5-step process make revenue recognition not as easy as we wanted it to be. Accordingly, the audit staff assigned to audit revenues should have the appropriate level of skills, accounting knowledge, and experience in auditing revenues, given that aside from these factors, the risk on revenues is also high as discussed earlier. Before performing any other procedure on revenues, the auditor must have fully understood the revenue sources and the relevant revenue recognition policy of their clients first. This is because not fully understanding the nature, sources, and processes of revenues and the revenue recognition policy of the client can result in an ineffective audit such that the risks on the revenues may not be identified by the auditors at all. So kung hindi mo alam, hindi mo naiintindihan yung revenue processes, malulusatan ka ng kliyente. Also, we should be able to assess whether our client's revenue recognition policy is appropriate for the revenue sources and whether such revenue recognition method complies with PFRS or other accounting frameworks being used by the company. Remember, as auditors, we should be able to conclude or make an opinion as to the appropriateness of the revenue recognition policy of our clients. So kung hindi natin naiintindihan or hindi natin naiintindihan yung revenue process ng company or even yung nature ng revenue ng company, and so hindi natin naiintindihan yung revenue, hindi natin naiintindihan ng revenue process, hindi natin naiintindihan yung requirement ng PFRS 15 for those types of revenues, paano tayo makakapag-conclude kung tama yung revenue recognition policy nila or hindi? Accordingly, if we have been assigned to audit revenues, make sure that we brush up our knowledge on the accounting standards on revenues as well as the revenue recognition policy of our clients. So kung hindi naman natin naiintindihan, sabihin na natin, for the sake of argument, wala na talagang ibang staff, wala nang available na pwedeng mag-audit. So ang binigay nating auditor is yung talagang hindi maalam doon sa ganong klase ng revenue or first time niyang nakita yung type ng revenue na ganon, then that auditor or even the team should on their own brush up na magbasa na, you need to read the requirements of PFRS 15 and based on the 5-step process, tingnan nyo kung tama yung, kung nagko-comply yung company doon sa 5-step process na yun or sa ibang requirements ng PFRS 15. Huwag kayong basta-basta na lang mag-audit tapos susundan natin kung paano ginagawa ng kliyente. That's not how we do audit. Dapat meron na tayong alam. Alam na natin yung gusto nating gawin. We know what we are looking for. Kasi kung hindi, malulusutan tayo ng kliyente. Possible na may error na sa ginagawa ng kliyente, hindi pa rin natin nakikita. The error could be staring us in the face and yet hindi natin nakikita. So parang that would reflect to our competence also. If we don't fully understand our client's revenue recognition policy, and know our accounting standards. Then how can we assess the appropriateness of such revenue recognition at all? So as I said, paano tayo makakapag um, conclude na tama yung ginagawa ng kliyente, na tama yung revenue recognition policy niya, kung hindi naman natin naiintindihan or hindi yung kanyang revenue mismo, revenue process niya mismo. So for example, kung construction activity siya, tapos POC siya, sabihin na natin percentage of completion yung ginagawa niyang revenue recognition process or policy method, pero kung hindi rin naman natin naiintindihan kung paano nagwo-work ang POC, paano pa rin natin ma-audit ng tama yung kliyente, di ba? So, we don't gain an understanding of the revenue recognition policy of our clients to enable us to give an opinion on their appropriateness only, but also because the attributes of each revenue sources are needed to identify where misstatements could occur. When we know where misstatements could occur, then we can design audit procedures that will address such misstatements. This means that gaining an understanding of the revenue sources, processes, and revenue recognition should be started in the planning phase of the audit and continued in the substantive testing stage of the audit. As we all know, revenues can range from simple, such as the sale of, say, candies to simple, such as the sale of, say, candies, to complex, such as multi-element arrangements, revenues from concession agreements, etc. Accordingly, the more complex and diverse our clients' revenue sources and revenue recognition policies become, the more we must ensure that we fully understand them. And again, we must assign a staff who has the appropriate level of skills and knowledge to audit revenue. So, maswerte tayo kung retail company lang siguro yung ino-audit natin kasi madali siyang intindihan. Pero what if multi-element nagkakaroon na ng multi-element arrangements na yung kliyente, may ino-offer ng multi-element arrangements yung kliyente, paano na tayo mag-audit? If we don't understand if we don't know our accounting standards and we don't know yung client revenue process. As you will notice, the first few steps in auditing revenues pertains to analytic reviews. This is because performing analytic reviews can also give persuasive evidence as to the reasonableness of the recorded revenue and can also give the auditor an idea of possible issues not only on the account being reviewed, but possibly on other accounts as well. However, we should always ensure that we use the right technique in performing analytic reviews since there has always been a tendency to over-rely on trend analysis. Pag nakita nyo palagi sa mga work papers, puro trend analysis ang ginagawa. For example, depending on our understanding of our client's circumstances and risk assessments, we may consider for a client with multiple stores nationwide to compare the results of operations of common-sized stores rather than maybe performing trend analysis to identify anomalies or unusual changes. In other words, the trend analysis may not always be the right analytic review technique to be used for our clients. We should tailor our analytic review procedures to the needs of our clients. In this regard, the analytic review procedures we will be discussing today assume that those analytic reviews or analytic procedures are the most appropriate for the client's circumstances. So let's discuss the first audit procedure, which is to obtain or prepare a comparative analysis of sales by product line, by location, etc., and other income accounts for the current and preceding year, and obtain explanations from the client for accounts that significantly change. This step requires us to compare information between two periods, the prior year sales and current year sales. In the Philippines, there are still many small and medium-sized companies that do not prepare budgets and forecasts. However, If your client prepares budgets and forecasts, a comparison of sales should also be made with such sales forecasts to determine whether the company can meet its targets and the reason for not meeting the same if such is the case. Analytic review can also be performed by comparing movements by month. You may note that the procedure also asks for a segmented type sales analysis that is not by total sales, but by product type, by locations, etc. This type of analysis applies only to companies with multiple products and/or operates in various locations. Why segmented sales, you may ask? Why not just compare the total sales for the year with those presented in the budget and the total sales from the prior year? Well, the answer is, it would be easier to pinpoint the factors that contributed to the change in total sales if we do segmentized comparative sales analysis. Segmented sales, if applicable to our client, would be easier to analyze compared to when total sales are used, since the segmented analysis is focused on the fluctuation of each product type instead of the whole total sales. It would be easier to pinpoint which product or products contributed to the change in total sales between the current year and prior year when segmented sales are used. The same is true if the sales analysis was made by location. We can pinpoint easily which locations made the most contribution to the fluctuation in total sales. Or if the total sales target was not met, we can easily identify which product type or location caused the company to miss the target. We may then focus our attention on these products and locations for further investigations if deemed necessary. So if possible, dapat segmented analytic review ang dapat nating ginagawa. The next analytical steps we will briefly discuss are first, reviewing sales activity by month, quarter for unusual fluctuations, and second, by comparing discounts, returns, and allowances with the prior year or as a percentage of sales. These two analytic procedures essentially involve trend analysis. Therefore, in this type of analysis, we compare information from multiple periods. At the very least, though, we use two periods in our comparison. These are the current year and the prior year. We do the comparison to spot or pinpoint unusual or unexpected patterns or trends. An example of the first analytic review procedure is when we plot our client sales activity per month to identify which month or months showed unusual amounts of sales compared to the other months in the current year. For example, a sudden spike or a significant decrease, whatever the case may be, in sales in November, when all the sales within the year remained relatively consistent with each other, should be investigated and discussed with the client if such significant change is not expected to occur on such month. Or we can compare each month's sales of the current year to the sales of the same month in the prior year to detect unusual or unexpected patterns or trends as well. For example, a spike or a big decrease in sales in March of the current year compared to March last year should be investigated and discussed with the client also if we are not aware of any event that would cause the sale to change significantly during that month. Here is a sample trend analysis for the sales made by a company's different locations during the year. In this particular analysis, the auditor was trying to determine which of the branches contributed the most to the overall revenue. So in this case, it is the Bataan branch. But we will not discuss this trend analysis in detail. I am just showing you this as an example of an analytic review using the trend analysis technique. We can use other analytic review techniques such as bar graphs, pie charts, scatter graph, etc. It is up to the auditor's professional judgment what analytic review technique would be best to use for their particular client. For the second analytic review procedure, our main purpose in performing such a procedure is to determine any unusual pattern in the discounts provided by the client from the prior year to the current year. For example, if there's a significant decrease in the discounts, returns, and allowances that were given this year compared to the prior year, we should investigate the cause of such decrease, especially if the gross sales remained relatively the same or showed a considerable increase. What did the company do this year that made it able to earn relatively the same or higher amount of sales without needing to give similar amounts of discounts from the prior year to its customers? Why were there fewer returns, for example? Because sales fluctuate, we usually not only use the absolute amounts of discounts to compare, but also the percentage of discounts to sales. Comparing the discounts, returns, and allowances as a percentage of sales with the prior year allows us to determine first the unusual or unexpected changes in the amounts, and second, how the company uses discounts as a marketing tool and how effective it is. Kasi nakikita natin, kasi let's say for example, ang dami niyang binibigay na discounts, halos sabihin na natin na nakakapagbigay siya ng 25% discount, and yet mababa pa rin ang sales niya. So there's something wrong with the possible the marketing strategy ng company or sa product nila or something that we may need to consider in our audit of the revenue account. Here's a sample trend analysis prepared for sales and discounts. As you can see here, there was a significant increase in discounts made in May, which we would normally investigate the reason for. So kagaya nito, halos consistent yung pagbibigay niya ng discount pero bigla nag-spike ng May. So for that, we have to investigate. As you can see, there are many ways where we can use trend analysis in our audit of revenue and other accounts. Trend analysis, if done right, is useful in spotting inaccuracies, errors, misstatements, or other issues in the account. I would like to emphasize done right. So if done right, maganda talaga ang trend analysis. The next audit procedure is to obtain a copy and test the clerical accuracy of the sales journal for months during the year and trace totals to proper posting in the general ledger. Sales journal is a report that shows the company's total sales in detail. This is also called by many other names such as sales book, sales module, sales list, sales records, etc. So iba-iba yung terms or names na ginagamit ng mga clients natin. Whatever name your client uses to call it, we need to ensure that such sales journals are clerically accurate before we do any other procedure on them. For companies, usually the small ones that still use manual sales books, where the sales transactions are manually written in ink, we need to dust up our calculators and computers to check the clerical accuracy of the sales recorded in the sales journal. For sales journal that is generated from computerized accounting systems such as SAP, Oracle, OnlyBooks, QuickBooks, etc., the sales journal may be exported to Excel for easier verification for clerical accuracy. Any material exception noted in the testing of the mathematical accuracy or clerical accuracy should be investigated. Once we have verified the clerical accuracy or mathematical accuracy of the sales journal, we should then ensure that the total of the sales of such sales journal agrees with the sales recorded in the general ledger. Any material difference between the two records should be investigated and discussed with the client. A reconciliation statement should be prepared or obtained from the client if deemed necessary. So kung let's say masyadong malaki yung difference, then we should ask the client already for a reconciliation schedule. The next step is to review the accounts receivable and sales accounts in the general ledger and the sales and cash receipts journals for unusual items and to investigate any unusual items observed. If you were able to attend or watch the training video for auditing receivables, you may remember that this procedure is also done for receivables. Accordingly, as I keep repeating, auditing of revenue should be done in conjunction with the auditing of receivables for more effective and efficient execution of the audit. So let's recap what was discussed in the audit of receivables, and then let's incorporate the revenue side of it. We said that knowing the client's business and industry will facilitate identifying unusual balances in trade receivables and revenues. For example, it will be unusual for a condominium operator to have trade receivables and revenues relating to the sale of goods if the company's business pertains purely to leasing of condominium units. Also, in our review of receivables and sales, we should also consider looking at receivables and sales that are unusually large or round in amounts. Receivables and sales posted during non-working days should also be considered unusual if we are aware that the company closes its operations during such days. Sales made to unusual customers should also be investigated. For example, a sale to an individual when the company's customers are expected to be companies only should be investigated. So, kunwari, ang mga, alam natin na, let's say, yung mga industrial air conditioners, usually, ang mga gumagamit niyan ay company. So, it would be unusual if the company sells an industrial air conditioner to an individual. So, for that, in that instance, we may need to investigate kung ano yung, kung valid ba yung revenue na yon or yung sale na yon made to that individual. In any of these cases, adjusting or reclassifying entries may need to be proposed by the auditors or be made by the client themselves. When companies become desperate to show increased revenues or profits, they sometimes resort to fraudulent accounting activities to enable them to show fake profits. As we have been discussing earlier, improper sales cutoff is one of the techniques used by airing companies to misstate revenues. It has been reported that improper timing of revenue recognition is the most common type of accounting fraud in the United States. And if there has been a study made in the Philippines, I am quite sure that the same result will show here in our country. So, in this regard, we should ensure that our procedures will be able to capture any accelerated revenue recognition done by our clients, if any. The next 3 audit steps we will discuss are connected and related to addressing these risks regarding revenues. Let's start with the first one, which is to check the numerical sequence of sales invoices and or shipping documents for completeness. To ascertain that revenues are recorded in the proper accounting period, several procedures can be done by us auditors. The first audit step is to ensure that the sales journal or subsidiary ledgers, which we will use as the basis for our next audit steps, agree with the general ledger balance. If they don't agree, then we should request the client for a reconciliation, especially if the difference is significant. Once we have ascertained that the sales journal or ledger balances agree with the general ledger balance, then we should do the next procedure, which is to review the sales journal for completeness of the recorded sales invoices or shipping documents. We do this by scanning the numerical sequence of the invoices or shipping documents. So, ini-scan natin yung tinitingnan natin yung sequence ng numbers. Any skip in the numerical sequence should be brought to the client's attention for their explanation. For example, if the sequence of sales invoices is skipped from number 201 to number 207, then we should investigate what happened to invoice numbers 202, 203, 204, 205, and 206. Why were they not recorded? Were they canceled? Did the cancellation go through the approved company policy on invoice cancellation? So things like that. We should be able to satisfy ourselves as to the responses of the client to these questions. Dapat ma-satisfy tayo sa mga sagot ng kliyente about skip invoice numbers. The next step, which is performed to ascertain that revenues are properly recorded, is to select shipment transactions from the shipping records from throughout the year and support proper recording by comparing information from the shipping documents to invoices and tracing invoice information through the accounting system to recording in the general ledger. In this procedure, we essentially follow the recording process of the company. So what we do is to select sales transactions for testing and then obtain the covering shipping documents and invoices for such transactions. We then compare the amounts and details presented in the shipping documents with the amounts and details presented on the invoices. Once we are satisfied that the details on the shipping documents and sales invoices agree, then we trace such details to the company's books to ascertain that the transactions were properly recorded. And then the final procedure that we will briefly discuss regarding completeness and cutoff testing is to test sales invoices, shipments, and issued credit memos days before and after the year end to determine that the sales were recorded in the proper period. This is a cutoff testing procedure that should be performed to ensure that no revenues relating to future periods are recorded in the current period or vice versa. To do this, for a client with an accounting year end of December 31, we examine invoices, shipping documents, and credit memos issued say 1 week before and after December 31, and then trace the same to the sales journal for December. All sales invoices, shipping documents, and credit memos that pertain to December should be found on the sales journal for December. If not, then an improper cutoff of revenues may have been done. Also ensure when performing this procedure that the dates of the sales invoices and the shipping documents are both in the same period. For example, both the sales invoice and shipping document should be dated December if they are recorded as sales in December. When the sales invoice is dated December, but the shipment date is January of the following year, then an improper timing of revenue recognition may have been committed by the company unless the said sale qualifies as a bill and hold sales, in which case we should also ensure to verify properly. And also, kapag meron tayong mga exceptions na nakikita, let's say, may nakikita tayong mga improperly dun sa 5 days before and after December 31 na sinelect natin na samples, may nakita tayong mga exceptions, meaning may mga errors tayong nakita, may mga maling revenues na ni-record sa maling accounting period, then we have to extend our samples. Hindi natin pwedeng mag-focus lang doon sa 1 week before and after. We will need to extend. So, gagawin na natin possibly 2 weeks na. So, titingnan natin kung gaano ka-pervasive yung error ng revenue acceleration. Kung acceleration ang nakikita natin, we need to seek kung yung pervasiveness niya doon sa libro ng company. So, at first glance, some may say that these audit procedures for completeness and cutoff testing are so textbook that erring companies could easily find ways to circumvent them. Well, frankly speaking, it may be true, given that up to this day, improper timing of revenue recording still exists. Hanggang ngayon, kahit na nagpe-perform tayo ng cutoff testing, meron at meron pa ring improper revenue recognition na nangyayari. Accordingly, when performing these procedures, auditors should always practice an appropriate level of professional skepticism given the high risk of misstatements attributed to revenue. We should not only focus on or look at the supporting documents and records, but we should also consider the controls being implemented by the company in their revenue cycle. For example, lack of proper segregation of duties can allow the commission of fraudulent cut-off of revenues without getting detected early. Aside from internal controls, we should also check for the existence of any motivation on the part of management to intentionally pull in revenues from the future to the current year. For example, the presence of pressure for the company to show better results of operations from, say, the investors, creditors, and other stakeholders should make us alert for possible overstating of revenues through improper revenue cut-off. The performance of adequate and proper revenue cut-off is crucial to ensuring that wrongly detected or recorded revenues are not recorded in the books. Accordingly, we should always make sure that we do this procedure properly. So let's review and answer together the next two activities that should help us understand this procedure better. So we are going to do an exercise for cut-off testing because this is a very critical substantive audit testing for revenues. So let's work together on this audit case to help us understand the revenue cut-off testing procedures better. In this audit case, CY means current year and NY means next year. So let's start. Let's read it together. The client, a store that opens 24/7, including holidays, provided us the following cut-off analysis. The cut-off analysis showed that on December 31, 20 CY, the company recorded the following sales. They also provided us the relevant invoices for review. So just take a look at this information. We also noted that there were no differences in amounts per sales invoices and the amounts recorded in the books, and that the client indicated that all these sales were recorded in the proper accounting period. So nakita nyo naman, nilagay pa nila properly recorded daw. Based on our examination of invoices and the books, we noted that there were no December 20 CY invoices recorded in 20 NY. So here are the questions. Should we agree that the client sales are recorded in the proper accounting period? So using this information, do we agree with the client that there's no misstatements or errors in their revenue cut-off procedures? If we do not agree that the sales are recorded in the proper accounting period, what matter or matters should we further discuss with the client? So if we don't agree, we think na merong mali sa revenue cut-off procedure nilang ginawa, then what matter or matters do we need to discuss with the client? So let's answer together. For question A, which asks whether we should agree that the client sales are recorded in the proper accounting period, the answer is no. Looking at the analysis provided by the client and by our review of invoices, there is an improper cutoff of sales made since there was a January 20 NY sales recorded during the period ended December 31, 20 CY. As auditors, we should request the client to reverse the sale under invoice 3525 in December 20 CY and push the recording of the same to January 20 NY. So, nag-pull in siya ng revenue in advance. For question B, which asks what matter or matter should we further discuss with the client, the answer is the skip invoice number. As you may have noticed, the numerical sequence of the last used invoice in December 20 CY is skipped from invoice number 3520 to invoice 3522. In this regard, we should ask the client about the unrecorded invoice number 3521. What happened to it? We must ask the client that. Why was it unrecorded? Was it canceled? Or maybe the invoice was not used at all? If such is the case, what caused it to get unused? In other words, we should be able to satisfy ourselves as to the propriety of the company's accounting treatment on the missing invoice 3521. So pag meron kayong cases ng skip invoices, you have to ask the client for the reasons for relating to those skip invoice numbers. Here's another question to see if we really understand the concept of revenue cut-off procedures. The question is, ascertaining that proper cut-off of sales was made by the company and ascertaining that all the reviewed sales documents agree with the sales recorded in the books are enough pieces of evidence for an auditor to conclude that the revenues of their clients are reasonably stated for the year under review. So kung may proper cut-off of revenue, enough reason na ba yun for us to conclude na reasonable na yung revenues recorded by the company? So the answer to this question is, it is false. While the cut-off procedure and the examination of documents may have resulted with no exceptions, the auditor should still look for possible fake inflation of revenues, which usually happens at the end of the year. Unusual spikes in the level of sales during the last part of the year, or unusual spikes in the level of sales returns or credit memo issued following the year end should be considered for further investigation as they may indicate, for example, revenue padding. An example of revenue padding is to recognize sales of consigned inventories as the company's own sales. There are many ways to artificially inflate revenues, which may not totally be captured by cut-off testing alone. Accordingly, we have to ensure that the combination of substantive audit procedures we perform on revenues must be able to address the results of our risk assessment process on such account. So hindi porke tama yung revenue cut-off, pwede kaagad tayong mag-conclude na tama na yung revenues na naka-record sa kanila. We have to perform other substantive procedures for us to be able to really conclude na tama yung revenues na ni-record nila. There had been a case actually in years ago na yung isang company, it is a Philippine company, na biglang nag-spike yung revenues, yung sales niya second week ng December. Starting second week ng December, third week of December, yung last 2 weeks of the year end, biglang nag-spike yung revenues niya. And then, the following year, napansin ng mga auditors, bigla rin namang ang daming niyang credit memos na in-issue. So parang, in effect, nag-recognize siya ng maraming revenues during before the year end, on or before the year end, pero binawi niya the following year, tinanggal din niya doon sa mga customers niya. So, this was an auditing case na hindi na publish pero nangyari to. Hindi siya napunta sa news basically, pero nangyari to talaga nagkaroon ng ganon, actual case siya talaga na yung company manipulated its revenue by spiking its sales on or before the year end, and then binawi niya yon through credit memos the following year. So to cap off the discussion on substantive audit procedures performed on receivables, let's briefly discuss some of the procedures that can be performed on some revenues other than sales. So those are the procedures. The procedures we discuss are for the core revenues. Let's discuss some of the procedures performed on the secondary revenues naman. Let's start with the first one, which is perform an overall test of revenue. This is for other revenues. In some types of revenues, the analytical review procedure can be used as the primary procedure. So, hindi na siya corroborative, but siya na yung primary procedure na ginagamit natin. This is when the results of the analytical review procedure gives persuasive evidence as to the reasonableness or unreasonableness of the amount of the recorded revenue. The analytical procedure I am talking about is the predictive testing, or what others call reasonableness testing. As the name suggests, this analytical review procedure attempts to predict the total revenue. Hence, if the amount we calculated is within the allowable threshold of variance, then we can say that the revenue is reasonable. This type of predictive testing can be used where the revenue is a fixed amount. For example, to test the tuition fee revenue of a school, we can multiply the published tuition rates of the school with the number of students by classification, for example. Or if the income is from leases, then we can compute the rental income based on the provisions of the lease agreement using a straight line method as required by the accounting standards. The same is true for companies using the percentage of completion method. We can test the total revenue recorded by the company by recalculating the revenue using the POC method. Please note, however, that the POC method, or percentage of completion method of recognizing revenue, entails estimates and judgments. Hence, we should be careful and also verify the estimates and judgment we use in our recalculation. So pag nagpi-POC testing tayo, hindi lang tayo compute ng compute. We have to consider also kung reasonable yung percentage of completion na ginagamit nila, or yung estimated cost of sales, cost to complete na ginagawa rin nilang basis, assuming na input method yung ginagamit nilang in recognizing POC. For revenues with variable amounts, we can apply the next procedure, which is obtaining detailed analysis of selected revenue accounts and tracing the details to the source documents. Examples of this type of revenue are scrap sales and the sale of assets other than inventory. So for example, nagbenta ng fixed assets. When significant, we should examine documents to support the recorded disposals of this type of assets. So when there are significant sales of fixed assets, tapos malaki yung gain, malaki yung proceeds, then we have to examine the supporting documents. So hindi siya pwede siyang i-recalculate using the gain on sale from the sale of fixed assets can be recalculated, but we have to examine the supporting documents first. The final revenue testing procedures we will discuss here is the testing of interest income or dividend income earned. Similar to sales, which could be audited in conjunction with trade receivables, interest income and dividend income should also be audited in conjunction with the related assets from which they come from. For example, investments or notes receivable. We usually do predictive testing for these types of revenue. So pag interest income and dividend income, predictive testing ang usual natin ginagamit. For example, dividend income could be calculated by multiplying the declared dividend per share with the total number of shares held by the company. The interest income, on the other hand, can be recalculated by using the formula principal times interest times time, assuming the related asset is subject to simple interest only. But if the asset is subject to compound interest, then we will need to do a recalculation that will suit this type of interest computation. So hindi natin pwedeng gamitin formula na yun, yung simple interest formula, kasi hindi natin mapipredict ng tama yung interest income. As I have said earlier, there are so many types of revenues out there, each with its revenue recognition method. Accordingly, we should ensure that we properly tailor our audit approach on the account and perform the audit procedures properly, effectively, and efficiently. So, ito yung sometimes nakikita kong, sometimes lang naman, kung minsan may nakakalimutang customize yung audit program, may meron na ako nakita before na POC yung revenue recognition ng kliyente, And yet, yung nasa audit program is for sales, parang ano siya, tailor-made for retail, for trading ng goods. So, hindi siya, so kung ako yung staff at gagamitin ko yung audit program na yung malilito lang ako at magiging mali yung procedure na gagawin ko. So, we have to make sure that we customize our audit programs properly. As I keep on mentioning in this series, revenue is the most commonly misstated account in a company's financial statements due to various reasons. Of course, not all companies try to misstate their revenues. As I have said so many times, misstatements in revenues could either be done intentionally or unintentionally by the company depending on many factors, such as the controls implemented by the company and or the objectives of the management. Regardless, however, of the circumstances of the companies we are auditing, due to the inherent high risk associated with revenues, we as auditors should always be wary of the possibility of the occurrence of misstatement in revenues. Dapat lagi nating iniisip na merong misstatement in revenue. In this regard, the design of our audit procedure should be able to address the risk of misstatement in revenues and related accounts. And we have always tried to do this. We have tried to tailor our procedures to the extent that we believe will capture misstatements. So why are there still so many reported accounting scandals involving revenues that auditors did not seem to have been able to capture? So pinipilit naman nating gawin yung tamang audit procedures, pero bakit ang dami pa rin lumulusot na revenue misstatements or manipulations? Well, here are some of the common reasons for that particular instance. Please note, however, that before we briefly discuss each issue or audit deficiency, that the list we are going to discuss is not all inclusive. Tama ba yung English ko? Mali yata. Just remember na the list that I am going to, the reasons, the common audit deficiency that we will discuss in a little bit is not all-inclusive. So, possible na merong pang ibang audit deficiency na hindi masasama dito sa i-discuss natin. But these are some of the reasons why may mga manipulations pa rin or misstatements in revenues na lumulusot sa audit. First is failure to fully understand the client's revenue recognition policy. The second one is the audit staff assigned does not have the necessary skills to audit the client's revenues. Another reason is failure to test the completeness of the revenues when appropriate. Failure to perform proper substantive analytical review procedures. Failure to properly identify the risks on revenues, and failure to test all the material revenue streams. So let's briefly discuss each of these. Let's discuss the first one, which is failure to fully understand the client's revenue recognition policy. Understanding of the revenue recognition policy for, say, sale of merchandise may be easy to do concerning the 5-step process required by PFRS 15. Madali lang siya, di ba, pag sale of goods. The contract and the performance obligation are easy to identify. The transaction price and the allocation of the transaction price and the performance obligations are easy to determine, and the time when the performance obligation is satisfied by the seller is also pretty easy to determine kung ang revenue stream lang natin is sale of merchandise. So if your client purely sells merchandise, then good for you. Your gaining of understanding of the revenue recognition policy of your client should be pretty straightforward. However, not all companies have similar cases. Some companies could be selling various products and services that require different revenue recognition methods. For example, a construction company may not only be constructing structures, but may also be selling construction materials and renting out properties. So each revenue stream, construction service, sale of construction materials, and renting out properties requires its own revenue recognition method, which we as the auditors need to be aware of. There might also be companies that, yes, also sell merchandise only to the cost, that sell merchandise only to the consumers, but at the same time attach to the merchandise certain elements to lure customers to buy their products. So, nagbebenta nga lang siya pero may mga attachment to the products. These sales of products and services with other elements attached to them are called multi-element arrangements. The understanding of the revenue process and the related revenue recognition method for multi-element arrangements will require more attention from the auditors compared to a pure sales arrangement. These types of arrangements would be harder to understand and therefore need to be studied and reviewed more as to whether the company's revenue recognition policy is following PFRS 15. Examples of multi-element arrangements are sales with loyalty programs attached to them. Ito yung pag bumili ka, may loyalty program, may card kang binibigay kasama dun sa, may card kang pinapascan dun sa cashier, and then you will earn points. This type of sales is commonly used by, among others, supermarkets and hypermarkets, pharmacies, bookstores, and gasoline stations. Another type of multi-element arrangement is the sale of products with a service type warranty. The existence of multiple arrangements could be obvious, like the sale of products with service warranties. Yung pag bumili ka, may kasama siyang warranty. However, some multiple arrangements may not be as obvious. Hence, we have to ensure that we understand fully our clients' revenues and processes to be able to identify possible other elements to the sale. Note that other than multiple level arrangements, there are other complex arrangements out there affecting revenue, such as, among others, concession arrangements or arrangements involving principal-agent relationships. Let's admit that sometimes some auditors really fail to fully understand the revenue and the related revenue recognition processes of their clients. So let's admit that. So when this happens, it becomes difficult for the auditor to determine whether the applied revenue recognition policy of the company is appropriate or not. Accordingly, to be able to effectively audit revenues, the auditor should have the appropriate level of knowledge, experience, and skills to be able to make proper conclusions as to the propriety of the client's revenue recognition policy. For example, for sales with attached loyalty programs, the auditor should be able to fully understand how the company recognizes the revenue, where a loyalty or rewards card was used, how the accumulated points are accounted for, how they impact the revenue from the product sales, etc. So, dapat naintindihan natin fully yung revenue recognition process ng company. Another example is revenue from construction contracts. When the auditor fails to understand the revenue process of the construction company, the auditor will highly likely be unable to design audit procedures that will respond to risks of inappropriate revenue recognition policy. Note that revenue from construction contracts often involve judgments like the percentage of completion method or the estimated cost to complete. Percentage of completion or the estimated cost to complete. So knowing how these judgment and estimates, including their reasonableness, affect the revenue recognition of the company is crucial to the audit of revenues from construction contracts. So to sum it all up, not fully understanding the revenue process and the revenue recognition policy of a client may lead to the team not being able to address any risk relating to the company's revenue recognition method. So may mga errors na hindi pa rin natin nakikita kung hindi possible na hindi natin makita yung mga errors kung hindi naman natin naiintindihan yung revenue recognition policy ng company. The next common auditing issue is that the audit staff assigned does not have the necessary skills to audit the client's revenues. As we have just discussed, some companies have complex revenue recognition policies. Accordingly, the auditor or auditors assigned to audit revenues should have the appropriate knowledge, skills, and experience to audit revenues, especially the complex ones. A junior staff with limited experience may not be appropriate to be assigned to audit revenue by themselves alone when the revenue recognition policy is considered complex, not often used as those for the bill and wholesales, or entails heavy estimation processes such as those we discussed earlier. So dapat commensurate doon sa type ng revenue, yung staff, yung level ng skills and competence ng staff na mag-o-audit nun. Or kung hindi siya ma-experience, wala siyang masyadong experience for that kind of revenue, dapat supervise na mabuti nung executives of the engagement team. In effect, in other words, hindi siya dapat iniiwan lang basta-basta to audit yung mga complex transactions. Dapat nire-review siya palagi and gina-guidan siya palagi nung nasa audit, ng audit executives. Plus, of course, dapat yung staff din should, as I said earlier, should brush up din naman on her own or his own, na maintindihan yung revenue process ng company and of course the related accounting treatment. So the next common auditing issue or audit deficiency is the failure to test completeness when appropriate. Completeness of the revenues when appropriate. As I have mentioned earlier, cutoff is often more crucial to revenues than completeness because most companies want to show higher revenues rather than lower revenues. Accordingly, companies tend to implement processes that would ensure that their revenues are completely recorded. However, as we also said earlier, there could also be times when an airing company would not record all of their revenues. For example, when the airing company has reached the revenue target for the period and saves the other revenues for the next period's target. So kung meron silang mga, kunwari, let's say yung CFO is being evaluated yung performance niya if na-meet niya yung target. Pwedeng pag na-meet niya yung target this year, yung ibang revenues niya ilalagay na niya sa following year. The issue of failing to test completeness arises for various reasons. For example, the audit team could not have assessed completeness as a possible risk when it should have been. So yung mismong risk assessment process ng audit team is flawed. Or the team considered completeness as a risk, but the procedure tailored to address the risk is not appropriate. For example, testing on a sampling basis the sales invoices recorded in the sales journal will not address completeness. So let's say in this case, na-determine na completeness is a risk in the revenue process of the company, and yet ang substantive audit procedure na dinesign is to test on a sampling basis the invoices. So hindi niya ma-check yung completeness kung ganun ang gagawin natin. So the next auditing issue we will briefly discuss is the auditor's failure to perform proper substantive analytical review procedures. As we have discussed in the audit substantive testing part of this series, of this session, an analytic review is one of the procedures performed in auditing revenues. However, auditors sometimes fail to perform this procedure properly. For example, the expectations or imprecise expectations are set by the team such that when such imprecise expectations are met, auditors readily conclude that changes in revenues, for example, are reasonable. Or sometimes the expectations used by the auditors in their analytic reviews are provided by the client. But such expectations were never substantiated by the auditors for their reasonableness or soundness. Most common, however, is when the auditors fail to corroborate or substantiate the client's reasons or explanations for deviations or difference noted. The next common audit deficiency is failure to properly identify risks on revenue. As mentioned earlier, unfortunately, it does happen sometimes that auditors fail to properly identify the risks related to the revenues of their clients, so much so that errors and/or misstatements in the revenues are not captured or properly addressed by the audit team because the designed audit program itself is flawed. Accordingly, the engagement partner or the lead auditor, if it's not a partnership firm, should spend an appropriate amount of time during the planning stage of the audit to get the overall audit plan right. Audit program should also be thoroughly reviewed and approved by the executives of the engagement team before rolling them out for the seniors and audit assistants to use. So dapat maayos yung audit program natin. The last common auditing issue we will discuss today, and this last auditing issue will end this training session na rin, is the audit efficiency of failing to test all material revenue streams. Ito madalas kong nakikita to. As we know by now, a company may have various sources of revenue. This is especially true for companies with diversified products. Sometimes auditors test the core revenues only and forget to test other material non-recurring revenues, or if recurring, maybe a new material revenue stream which the auditors fail to identify during the planning phase of the audit. As a result of the auditor concluding that there are no new revenue sources, the prior year's audit procedures were therefore deemed to still be appropriate for the current year's audit. No audit procedure was therefore designed to test the new revenue source, even if such revenue source is considered material to the audit. So madalas kong nakikita ito actually, yung ang natitest lang natin is the main revenue, pero doon sa ilalim, kung minsan may malalaking other income, hindi na natin tinitingnan. Either wala kasi siya sa audit program, so yung staff hindi niya ginawa ng procedure, or talagang kasi nakafocus lang tayo sa core revenues, which is incorrect. Remember, meron tayong tolerable error or performance materiality level na sinusunod. So dapat anything, kahit na anong mangyari, pag umakyat siya doon sa or na-meet niya yung threshold na yun, dapat ginagawa natin siya ng procedure, whether nandun siya sa program or hindi. Kasi kung minsan talagang nakakalimutan sa audit program, syempre yung audit program, ideally, dapat na-capture siya kasi dapat na-capture na yon during the planning phase. But assuming hindi talaga siya na-capture during the planning phase, may bagong income na nangyari after nating gawin yung audit planning procedure, dapat so nag-design na tayo ng audit procedure hindi kasama yun dahil hindi nga natin siya nakita during the planning phase of the audit. But since nandun na yung materiality level natin, dapat yung even the audit, yung staff mismo, dapat nagkukusa na siya, nagawa niya yun ng procedure kasi na-meet niya yung testing threshold natin or yung performance materiality threshold natin. So, dapat hindi na niya hinihintay na dapat nandun sa audit program kasi nga possible na flawed yung audit program. But as I said, anything that meets or qualifies doon sa performance testing level natin, whether nasa audit program siya or wala, dapat gagawan siya ng procedure. Kung wala siya sa audit program, sabihan nyo kaagad yung senior na wala siya sa audit program. If you do not know what to do with that particular revenue, then ask for your seniors or the executives of the team kung paano nyo dapat i-tackle yung revenue na yung kung paano siya i-audit. And then, ask the senior to update the audit program para ma-include siya doon before the archiving of the work paper. So actually, so that's it for revenues. So thank you everyone. I hope you learned something. If you have any questions about revenue, feel free to contact me or ask question kahit outside of this training session.